I am John Najarian, and RebelCon 2022 is almost here. We do have a virtual pass. The virtual pass gives you full access to everything, all the streams, the live trading sessions, all of our fabulous keynote speakers. So to learn more about what's going on at RebelCon 2022, whether you're in person or virtual, check out marketrebellion.com/Dallas.
And good afternoon once again, Market Rebels. Thanks for joining us here at Market Close, as we do every Monday, Thursday, Friday at 4 p.m. And boy, are we glad to get that one behind us today after such a massive sell-off. I didn't see the actual close, but the major indexes were down 3+%. I think the Qs were actually topping out over above 4, so those are really heavy sell-offs. So the market definitely did not like Powell's comments coming out of Jackson Hole, saying that they're going to continue with this aggressive tightening, that history has shown that trying to relax too soon doesn't really fare well for the markets, which is true. But who would have thought that it would have had that big of an effect? But we sure did. So on a brighter note, we've been talking about put-call parity and synthetics, and this can be a really good example of when they can come to help you a lot, because we can start getting some very big skews between the calls and the puts on days like this, and it can certainly make a big difference in the way that you're setting up your trades. So if you've joined us for the last 2 weeks, we've been talking about put-call parity and synthetics in a variety of different ways and different formulas. And what I said I would do today is to show you what I think is one of the more interesting looks in all of the formulas and put-call parity. And it is to help traders to understand one of the more confusing topics in all of options, and that is that calls are puts and puts are calls. You've heard us say that before. We say it all the time in the webinars and the Q&As, but still a lot of times traders don't really understand what that means. They think, it's just some kind of a cute little catchy phrase, but I don't really understand why they say that they are really the same. Well, that's what I'm going to show you today. I'm going to show you with a very nice graph that you've probably never seen before, and it really shows why they are exactly the same thing. It just depends on your viewpoint. Now, a little word of caution, there's a tiny bit of math in here. Sometimes it's inescapable when you're talking about mathematical formulas. Yes, there's going to be math. So I'm going to try to keep it as simple as possible, but the main point is that you get the concept. All right, so just try to follow along the best you can. And for all of those of you in the Q&As, you can certainly ask questions later. So why is it that calls are puts and puts are calls? Well, as I've shown throughout the past couple of weeks, you can change a put to a call by simply buying shares. And you can change a call to a put by simply selling shares. It just depends on how we delta hedge them. And I showed you a formula where you could just look at the risk graphs and tell what the synthetic is. So if you remember, we said, for instance, what's a long call? And you know that immediately has to be a long put, because a call is a put is a call. So if we're trying to replicate a long call, you immediately know that part of the synthetic must be a long put. They've got the same sign. They're both long. We're just flipping the call to the put. But then we have to say, what's the delta over here? Well, this delta where the line is leaning upward to the right like that is long shares of stock. And so there's your answer. It is a long put plus long stock. So once you understand the formulas, you can get around this stuff very easily by just looking at them visually and coming up with the answer. Here's another one. What's a long put? You immediately know part of the synthetic must be a long call plus something, some type of stock. The stock is what gives us this angled part of the line. Well, this line is leaning to the left, so that's short stock. And so there's your answer. It's long call, short stock. Super easy. That's why don't worry too much about the formulas up front. We do that just to give you a safety check to make sure that you're getting the right answers. But as you get more advanced, you'll be able to just look at this stuff and immediately tell your synthetic counterparts. So for today, we have to revisit an equation that we've seen before. And I'm going to make this presentation today a little bit easier. I'm going to simplify it a little bit. We're not going to be including the interest portion. So when we're at expiration, a formula we can use for synthetics is that stock plus put minus call equals a bond. And this is what kicked us off 2 weeks ago when we looked at how a market maker would fill an order and come up with this type of a trade called a conversion to fill that order. And we found out it was a locked trade. It behaves like a bond. So for instance, let's say that the stock is at 110. Oops, sorry, these are out of order. There we go. Stock is at 110. The $100 put would be worth 0. The call would be worth 10. It's $10 of intrinsic. So look what happens. We take 110 plus 0 minus the $10 value of the call, and it comes up to the $100 exercise. So it turns out that we can replace the word bond with the exercise price. It's going to behave just like a T-bill with the face value equal to the exercise price. So in this example, it would be like having a T-bill that matures to a value of 100. Now with this formula, look what we can do. We can rearrange it. I could say that the call must equal the stock minus the exercise plus the put. That's just this formula right here rearranged. But look at what it's telling you. Don't worry so much about the formula. Look at what makes it tick. What is stock minus the exercise? That's the intrinsic value, right? If the stock is 110 and you've got the $100 call, there's $10 of intrinsic value, stock minus exercise. And then over here on the end, plus the put. The put is telling us the volatility component. So that's another easy way to quickly come up to the formula. A call must equal its intrinsic value plus the extrinsic value. And if we're trying to solve for the call, the extrinsic value we could say comes from the put. I can flip it around. I can say that the put would be the exercise price minus the stock plus the call. Again, it's just this formula right here rearranged. What's the exercise price minus the stock? That's the intrinsic value for a put. So think about what it's telling you. A put must equal the intrinsic value plus the extrinsic value. Now I'm just saying that the extrinsic value is coming from the call. Pretty weird. How is all of this playing out? How does all of this work? And again, this is what causes the confusion for traders. Now, what's important for right now, I want you to keep your eye on this one in red. Okay, a put is equal to the exercise minus the stock plus the call. So prior to expiration, we can also say, we can tighten up these boundaries and say that the call must equal the stock minus the present value or today's value of the exercise plus the put. We're just changing this one little thing from the exercise to the present value. So take a look at this. In the example we've been using for the past couple of weeks, we had a $50 stock. Interest rates were 5%. So if we take $50 divided by 1.05, today's value of that exercise price, or let's call it of that bond, is $47.62. That's saying that if you deposited $47.62 into a bank at 5% interest, it would grow to 50. That's what it means to be today's value. So now look at what it's telling us. The call equals 50 minus 47.62 plus the put. 50 minus 47.62 is $2.38 plus the put. So what is this telling us? It tells us the call must be $2.38 greater than the put. Was that really true? Well, take a look. Here we go into our Black-Scholes model. Call is worth 438, put is worth 2. This is the example that we used from 2 weeks ago. We assumed that the put was 2. We figured out the market maker must sell that call for 438. It's exactly $2.38 greater than the put. What if we had no volatility? Let's take the volatility from 1576 down to 1, which certainly would never happen in a market, but you do that just to make the point. If we had no volatility, look at that. Now the call's got to trade for at least 238. there's the interest component on the option. So once you start to work these formulas around, it will add tremendous insights. And I know it's probably not going to make a lot of sense now, but when you look at strategies, it's sometimes easy to think that there's a lot of extrinsic value in an option, and it might just be the interest component. That used to happen a lot with Amazon when it was $3,200 and the options looked like they were outrageously expensive. That was all from cost of carry, not from extrinsic value. And if you don't know that, you could be led down to make bad decisions in your trading. You need to know where these pricing relationships are coming from and where that options price is getting those values. So now with that little background, let's go take a look at it visually. Here's our risk graph for shares of stock. And what we could do is we could just divide up the stock at an arbitrary point at the exercise price. That's really what you're doing with a strike price. You're saying, I don't want the stock all the way down to 0. I only want to own it above 50 or above 100 or something like that. So we could make this little horizontal line anywhere we want. That would be the exercise price. And if you look right there, there's your hockey stick graph. That's another way of understanding where that risk graph is coming from. So over here we have the stock minus exercise. That's our intrinsic value. But there has to be more to it than that. There has to be an extrinsic value, and that's where that graph comes in. All right, so now keep your eye on, there's the hockey stick graph that we saw. The area here in white between the red and the blue line is the extrinsic value. That's the time value. That red line is going to slowly start working down towards the hockey stick. But take a look at what it's telling you now. It says that over here we have the stock and the exercise price. That's the intrinsic value. This little space up into here is the extrinsic value. So it's telling us that here is the intrinsic and here is the extrinsic, and the call's total value must be the red plus the green. So how is it possible that a call is a put and a put is a call? Well, what if we looked at call minus stock plus the exercise? Isn't that what that's telling you? If we look at this space over here, call minus the stock plus the exercise would be this area. We would get red plus blue, and guess what that is? What's call minus stock plus exercise? That's your put. And there it is. So even though we look at that as the risk graph for a call, if you just let this be the intrinsic value of the put, it's exactly the same extrinsic value. So see, what you're looking at is here's the intrinsic value for the put, there's the intrinsic value for the call. It just depends on whether you want to look below 0 and include that, in which case you're talking about puts, or only above 0, in which case you're talking about calls. But both the call and the put share the same extrinsic value. And so that's a beautiful way to show that if we line it up just in terms of a call, and we take call minus stock plus the exercise, that is our put call formula for a put. So once again, I know that might not make immediate sense to you, but it's just to at least take that first step. But I can definitely tell you it's an incredibly important part to succeed with options. So always remember that when you change the way that you see options, you will change the way that you see strategies. So if you'd like to do that, we'd like to invite you to join us with a free 30-minute one-on-one consultation with one of our world-class coaches. Many of them have had decades of trading experience on the exchanges. Would love to sit and have a one-on-one consultation, chat with you about anything that you want. If you want to talk about your style of trading, a particular trade, options theory, whatever, but they will show you how these key insights and all the little market maker tips and tricks can make you a better trader. And that's really what this is all about. So you can't beat risk-free, absolutely free. So please give them a call there. It's 888-809-8058. And we'd love to have you join us for a free consultation. Please join us at 5 p.m. for cocktail hour. And if not, I want to wish everybody a very happy weekend. Try to put today's trading day behind you, and we'll see you next Monday. Thanks so much, everyone. Have a great weekend.